Hi, welcome to McBoss Capital channel. My name is Michael Chu. Here today to talk about the market recap for this week, ending August 2nd, 2024. This is quite an eventful week in terms of what the market is doing, and we're going to talk about maybe part of the reason why the market is going down quite a bit, and whether there's more to go in terms of melting down, because there's lots of tweets I see about this, whether short term or long term, we're not sure. So here's a weekly chart of the Nasdaq. We have a really nice rally in the last, few months, for about 12 weeks up, and then we start to see deterioration in the market, and now we're on the third week down. And as you can see, it is below the red line, which is the 50-day moving average, which is this right here, this red line, and we are seeing the black line 200-day right here, moving average, and we kind of in between those two right now. So you can see the levels right here. Could it come down to 200-day? Possibly, especially if we can see a meltdown. The other thing is, we are near the previous base at the high here. So we near that level. Whether we'll get support there will be important. Because we have sold so much this week. I think the market was down, what was it? 3.3% on Nasdaq. There's a high chance of a bounce here. Before, even if it's a downtrend, it might bounce and then come back down. So, we're looking maybe a couple 2 to 3 days bounce, and and then maybe it'll fade again. Or we could see a really strong rebound and we might see a V-shaped recovery. That's also possible. So it really depends, right? Like what kind of macros and it's going to come out that will affect this market. Part of the reason for this drawdown, there's lots of tweets about this, even CNBC talk about it, which is the yen carry trade, which is people buying yen in the many years, even decade long, because of low interest rate in Japan, and then they'll basically try to use that money to make money somewhere else, right? So that's what. But because Japan, I think they raised the interest rate recently, like I don't know, Wednesday or something, by a quarter point, and then all of a sudden this yen carry trade thing starting to unwind, and people are starting, and this is what's causing a part of this meltdown. Not sure how true that is, but at least people are talking about it, and it's causing a possibly a bigger problem. So here's the news here. The Bank of Japan increases key interest rate to 0.25 from the previous range of pretty much near 0%. And this is they also outline a plan to unwind its bond buying program as it eases back from a decade of stimulus measures. So this news, like I said, happened a few days ago. But like I said, I don't know, it was Wednesday night over there. But this is causing a big meltdown here, in general. And I'm not sure, again, how much of this is affecting the market and whether this will be continue. If this is true, then probably we will see more meltdown, right? Because it's not going to be a one-day thing. This could trigger a lot of investors just moving off whatever their carry trade is. So anyhow, I just want to mention this. This is a post on Twitter X by Rand here, and it says here, for 30 years Japan has 0% interest rate on the currency. As a result, 30 years investor borrow yen at no cost, invested globally, right? They invest in T-bills abroad and basket of risk assets, including the Nasdaq. For the first time in many years, the Bank of Japan increased interest rate this week, right? And as a result, this increased interest rate and the signal to the market investors are now concerned the money they borrow for free is no longer free, and they are now unwinding their trades and sending funds back to Japan. And I don't know, it says here, this is a huge number. It says the quantum of this trade is over 4 trillion. The only question remains how aggressive they will be, but for now you must keep your eyes on this chart, and you can see the US versus yen is starting to come down, and that's what's part of the problem. So yeah, we're gonna be watching out for Sunday night here in North America, and then overnight in Nikkei, and see what's happening there. Obviously, you can see on Friday, the market kind of crashed a little bit, like 5.8%, and as the currency dropped significant, as the currency kind of, against US has increased quite a bit, and so yeah, we'll see if this carries on Monday. Again, on X, I'm seeing some people saying this could be a Black Monday. There's definitely lots of fear right now in the marketplace. Whether we see, if we don't see that drop, then probably, I would say a likely short-term rally is going to happen. At least to test, to come back a little bit and just see where things go after that, whether there's more macro news that could affect the market. So let's quickly look at Nasdaq on the daily chart. So we have this week, we already started this downtrend, the 10-day moving average sloping down, and you can see here Monday, market was trying to recover still a little bit, didn't really move much, still under the red line, which is the 50-day moving average. And then Tuesday it gave up more. It didn't make a new low, I don't think so. I'm not sure, very close. But again, it gave up. And then Wednesday we have this gap up in the morning that's really strong right before the Fed announcement on their policy, and then that day was quite volatile. Let me jump to the intraday here. So this is Wednesday morning. Very strong gap up. It remains pretty strong throughout most till around 2 Eastern time, right before the Fed announcement, and then it even jump up more, right, and make a new high. But in the last hour, right, like almost the last hour, like a little bit, it starts to come down, and then it kind of closed a little bit in the middle range right here. So everything looks good, and then on Thursday morning, it still even move up, and that was probably the trap right there. And in the morning, and if you bought into this thinking, hey, the Fed is good with possibly cutting rates in September, and which is right now we're August, so September, yeah, a month and a little bit, then possibly you got trapped here, and then from there we pretty much went downhill. Like, this selling is incredible in terms of strength, because there was really not much uptick, and then there was some little relief in the last hour a little bit. And then Friday we have this gap down, right? And again, this and then from here we kind of didn't go down too much. Like in the morning it went down hard, but it was able to close again in the middle range a little bit, not accounting for the gap down. But overall we have suffered considerably in terms of the index itself. You can see whether this is we see the gap down right here, right? And probably the most important thing is the 10-day moving average. It definitely couldn't surpass it right here, and then it went further, right? Like this was a huge down there on Thursday, and then Friday we gapped down. So now like I said, on the weekly chart we saw we are stuck now in between here, this range right now, and this is the previous base right here. So we did come close to the previous high here. So I don't know if that's a successful test. Usually it will test a couple of times. So as the 10-day coming down, it might rally back a little bit or sideways towards the 10-day, or it might go stronger towards the 10-day right away, and then we'll see how it reacts again as the 10-day comes down, right? In the downtrend, that's what happens. It keeps getting rejected at the moving average, at least the short-term moving average, and then as this 200 days is going to come up closer and closer towards the price, at some point they'll meet, and there'll be another test. Again, this is assuming there's more weakness to come, which I don't see a reason why not. We're still in the middle of earnings season, lots of volatility. Lots of stocks are getting hammered when they have bad earnings right now, more so than the reward side when they have good earnings. So I've seen so many stocks, like I'm scouting all over the place for any stocks that try and resist this downtrend. And there's a little bit, but not a lot, right? And we'll look at some charts on the stocks list after. But in terms of what's happening right now, it's just a lot of selling. And you can see volume is like pretty high on Thursday and Friday. Obviously Wednesday, even though it was up day, again, lots of volume. And not sure how much of the macro will continue to affect this. Obviously, there's the Middle East war getting more worse, and Iranian may attack again this weekend. So lots of macro news, earnings news are halfway through, and so far I heard the numbers are on the reward side is much less than on the downside whenever they miss. So anyhow, just want to talk about this. Let's jump back to my notes here. Again, this Thursday morning gap up and then reversal was very ugly. It's an expectation breaker according to IBD, and there's no way of sugarcoating this market. It is pretty brutal right now. Major correction mode right now, taking down most sectors. There's some safety, in some consumer staples and utilities area. For short-term traders, risk management is really key. A lot of my stops got hit, so that automatically pushed me out in many positions. So hopefully, again, I don't know how much more this will go down, but like short-term, we're definitely seeing some sort of washout. Whether there's more to come, possibly a couple strong more days of downturn, a lot of people will be washed out in terms of stops getting triggered and so forth, and then we should see a bounce, and then we'll see how strong that bounce is, coming back to the moving average. We're seeing market breadth also somewhat deteriorating, not as bad as I thought. Here's the accumulation distribution, obviously very low at E, both on S&P and Nasdaq down. This is for IBD newspaper. And then you can see, we have this index here going down, crossing the 50-day moving average, on both Nasdaq and S&P. And the advanced decline line is, you can see Thursday, Friday down. But so you can see on Friday 1809 stocks down, 511 stocks up. So it's not a complete washout, like you're not seeing a 10-to-1 or 9-to-1 ratio. This is probably like a 6 or 7-to-1 ratio here. No, actually not even that. Around probably 6. How do you say it? About 30%, 35%. Yeah, somewhere around there, 30% ratio. And then here we have, but the Nasdaq, you can see like it drops a lot more. 2,900 stocks down versus 500. So this is this is a 4-to-1 ratio almost. It's definitely more selling on the Nasdaq side. So we're seeing lots of macro risk right now, and then even on the Fed Wednesday announcement, they are willing to cut rate in September, but right now are the Fed behind the curve? That's the problem, because numbers on Thursday and Friday from the job side are very weak, and so there's fears of recession and economy slowing down much faster than originally anticipated by the Fed. And so right now there's a 50 basis point CME future on the rate cut predicted for September. So on September 18th is the next Fed meeting, and right here, and you can see. I just refreshed the screen, but on Friday morning, when I looked at this, it was actually 50 points cut was quite high, like it was like 60% or something. But now it seems to have reversed by the end of the day. So now it's still a quarter point cut expected in September. So I'm not sure what makes this turn around, but in the morning, like I said, but there's definitely more people talking about a half a point cut in September, but at least the future now has changed back again to just a quarter point cut in terms of highest probability. So let's look at Thursday and Friday in terms of economic news. We had this Institute of Supply Management Manufacturing Index came out, and it slid to 46.8% in July, the fourth straight month of decline. So this really points to a softer economy. And then on Friday morning, we had a big miss here, where the Labor Department non-farm payroll for July rose by only 114,000, much less than 180,000 expected, and down from June revised 179. So this really kind of give a gut punch to the market on Friday morning once this news came out, and the market continued to deteriorate after that. And then unemployment rate also shot up to 4.3%. Here we're looking at the IB newspaper. You can see job report weak across the board. Here's the 114,000, which is very weak considered compared to previous months. And then we have the jobless rate here, kind of shot up to 4.3%. Kind of a little bit accelerated right now, and that's what's spooking the market as well. Again, we are still in the midst of earnings season, and we already started to see a week ago how the VIX has starting to move up, and this is last week, and then this week you can see we really saw up like Thursday and Friday, right? This is a huge range here. We can go backward a little bit now. Look at the weekly chart, and you can see we are at 30 zone. We went as high as 30 zone, which is kind of back to early 2003 level kind of volatility. So yeah, I mean, we see spikes all the time, like even before. Usually they do last 1 or 2 days and subside for a little bit before they come back up. Like here you can see it went up and then comes down, goes up, comes down. So it's definitely volatility can be very scary. And we expect the same thing here. We might die down and then jump back again. Again, it really depends on what kind of news come out, but right now we're just seeing more volatility, so definitely stay more cautious. So here's the Nasdaq daily chart. What I want to show you here is this channel, bottom channel line. We did break it on Friday. That's the we gapped down below this line, and so that's the negative. Because we no longer are above this channel line, the market was able to let it come down below that, and that's usually not a good sign. We could see more deterioration going forward as the 200-day comes up. They might get challenged there at the 200-day and see how that works. But again, this is not looking good in terms of a long-term trend. It has broken its support on Nasdaq, and then if we look at the QQQ, which is the ETF for the Nasdaq 100, it's also similar. You can see also this one's even more clear. It broke that channel line, and then we go to equal weight. So in the without looking at the broader Nasdaq 100 stocks, we can see this also kind of got challenged at the 200-day right here on the black line. And it also fell support over there. So this is kind of leading indicator, because this is a broader scope, because this is equal weight, so it's not just focused on the big caps, right, the mega caps. So here we broke it, and so that's another really negative. Whether we come back right away, we'll see. That's very important. If we can come back right away, there's a higher chance of success. But if again, we're seeing this downtrend line right now on the 10-day at this slope. So we do expect some bounce here, because it just came off so fast. Like, I mean, we could see either just one or two more day of like sharp drop and then bounce back, or we can just bounce back right here back to 10-day. But doesn't mean this downtrend is over. Again, if you're following IBD rule, we're looking for a follow-through day, which is like after a low is made, we look for 4 days of uptrend, and if it can hold that 4-day and break above that on high volume with at least 1.2% gain, then we consider that follow through day. But even then, after follow through day doesn't mean every time it will work, especially during a market correction. Follow through day do fail quite a bit, at least the first couple. So lots of things to consider. It's definitely not time to be aggressive. If you're thinking that, stocks have dropped a lot, it's time to buy. If you're a long-term investor, definitely a good thing. But if you're a short-term, there could be more volatility going forward, and it's just gonna chop you up in many ways if that continues for short-term traders. The other thing to note on the equal weight is that Nasdaq here is that if we look at the early on in the year, we are around this level. We are actually, if we go across right here, from here to here, we are actually like year to date, the equal weight Nasdaq actually are at near 0%. Pretty much it hasn't made any money. So this is also a very interesting fact here that this is, you know, hasn't made any money for equal weight Nasdaq as well. So again, there's no sugarcoating what's happening in the tech sector. Definitely got hit the hardest, especially in the chips area. This is SMH, the semiconductor ETF. It's down 22% from the high right here. So it's very sharp drop. You can see it almost already near the 200-day line. And let me go to the daily chart here. Like obviously the volume is just crazy insane here. And here we go. Right here's 200-day. The bottom of the previous base is 198, and even the black line, which is 200 days above that. So I'm not sure, like, it'll test just the black line, whether it'll test if it undercut this base, it might be better, because then it kind of resets all the bases for most stocks, and that could, you know, set a new stage for the next rally, and they all have a clean start. Because think about it, anyone who bought in this range are pretty much now near flat or underwater. So lots of people would have given up by now, and this is a flush of a lot of investors. You know, they may be very fearful right now, and if it flushed most of them out, then this could have a more prolonged uptrend after that. You know, because this uptrend has been running for quite a while, right? Like, you know, in general, not just semiconductor, but they're obviously the one of the biggest gain in sectors, right? And yeah, you know, from the October low 2022, we are, you know, we have come a long way. You know, this index itself has probably more than doubled for sure. In you know, since October 2022, we are in August, so like 1 year and 10 months. Roughly, and yeah, so now we're giving back, and this is definitely the sharpest correction so far in this whole run. And so we're gonna look at the leader here in that group. Nvidia, you can see it's down to almost 23% by end of Friday. It's you know, it's definitely the biggest runner here. So yeah, with the SMH semiconductor group down around 22.5%, and this one down 23%, it's almost on par. So yeah, this one's, you know, definitely on a downtrend. We don't know how deep this correction could be. So we have to, you know, probably be careful. Even though, you know, you always think it correct on so much already, it can definitely correct more. So be careful about that. Just want to show you this from Jaguar here. This is what the drop looks like right now. 27% for Nvidia, well, roughly 23% we just saw. So this is probably not up to date, but anyhow, ARM close to 40%, AMD 40%. You know, Intel obviously had a big drop on Friday due to earnings. Huge drop right there. You know, there's really no hiding here. Every chip is just getting hurt. Here's the SMCI chart, 49%, right? You can look at ARM. Again, this one, 40%. This is a really sharp drop back to the 200-day. So some of these stocks are already hitting the 200-day. You know, and this is the previous base low. Not sure how far it will go, but that's a very deep correction. And then we have AMD. Again, also 40%. Really sharp correction. So, you know, again, most of these stocks have ran, even, you know, not even some of the weaker stock in this group, but they're really definitely, you know, testing your patience. Even if you're a long-term investor on the chip sector, you have done really well, but now you know, it's giving back a lot. So again, Nvidia is the leader in this group. They haven't obviously announced earnings. It will be in about 25 days. So whether this the chip sector, a lot of them have reported. So most of them, I think AMD did well, but even then it couldn't go up. So that's probably tells you a lot about this market. So here's the chart of AMD. I think Wednesday it report good numbers and it went up, but even then, look at it, it's just coming down as the sell continues. Again, right now the macros are going to dominate the market even more than the earnings itself. So it's so a lot of stocks are selling off even they reported good, right? Now there's very few, like I found a few stocks that are not going down and they had good earnings and they still went up, but most of them are like getting hammered. But for longer term investors, probably this is a buying opportunity because they have corrected quite a bit. So something to consider. Here's IGV, the tech software group, and you can see we failed this base breakout and it has come down since, and now it has accelerated, and not only that, it went below the 200-day moving average, which is the black line here. And so again, we'll see what happens at this area, whether it will try to come back and test this. And really, if you go back above the 10-day, that would be really good, especially here is the long-term average 200-day and bounce back up. It's definitely possible. Here's Microsoft. We'll look at weekly charts, since really daily action right now just doesn't make a lot of sense to even look at because it's just going to be volatile. But on the weekly basis, you can see we have hit the 200-day right here on the black line. We are down 12% on Microsoft. Next we have Google. This is also correcting. This one is slightly better because it's not at quite a 200-day, but this is also down 13%. Meta actually did pretty well on their earnings, so it's only down 10%. So on Thursday you can see this gap up in the morning, but it did reverse by the end of the day, and then on Friday it gave up a little bit more, but it did close in the middle range. So there's some support for this stock. So it's looking definitely better than other stocks, because again their earnings did help quite a bit. And here's Amazon. Didn't do well on earnings. It really went down on the earnings, gap down, I believe. 16% down now. This is now below the 200-day, which is the black line. So this looks probably the worst right now out of the mega caps. Let's look at Apple as well. Apple is holding up pretty well. I think there was news just came out from Berkshire. They sold a lot of their shares, and something like half or something of their shares in Apple. I'm surprised this stock is still holding up so well despite they selling so many shares in the last quarter. Again, this has a lot of expectation around the AI phone possibly coming up this season, and that's the reason why it's holding up so well and also going up as well recently. So this is definitely still in an uptrend. So this is only down 7% so far. And finally, we have Tesla in the mega caps. This one also corrected. Now we are down to the 50-day and 200-day, which are converging right now. It's quite a bit, 25% from the top here. So here's the S&P 500 chart, very similar to Nasdaq. This is the weekly chart. We are also on the 3 weeks down. Now we are below 50-day moving average, the red line. We look at Dow Jones. Dow Jones is still not bad. Like you can see, the previous 2 weeks it was kind of, the relative strength is stronger because it's acting better than the S&P. And then this week it did reverse, but it's still above the red line, and so there's definitely support right here. But again, this is acting well compared to other index. And then finally we have Russell. So Russell was taking a lot of leadership since the bounce right here, and we have this 5-day run, and then we pull back, and then we start to go up again, and then Thursday again it reversed right from the morning. It hit new high and then reversed, and then we see this really sharp drop in 3 days. In fact, you know, Thursday and Friday, it dropped more than other indexes, which is you know, really kick out a lot of my stocks that are part of small cap area, and you know, and the mid cap as well. I think if you look at MDY, you see the same thing here happen on the mid cap. It also dropped down really sharp here, and this one is below 50-day moving average. To the Russell, this is definitely a pullback to the previous level around 2100, and here's the red line, which is the 50-day moving average. Right now, my expectation is that this will bounce, at least for the short term, and this is the 10-day slope coming down this way, and so we'll see how it reacts again around the 10-day moving average. Or if things doesn't go well and it gets, you know, kind of rejected here, then we might see it go back down to again the 200-day moving average here, or at least this channel line right here. So somewhere around there. First level of test and the second level here. So the regional banks have been really doing well for the Russell, and here's the trend right here. You can see it just keep nice uptrend here, and then it really fell apart on Thursday and then Friday, right? So you know, it kept below you know, the 21-day moving average. So most stocks are, you know, if you have financial stocks, that's kind of like the comparable to see whether it's below that line, and most of them probably are. And you know, for me, most of my stocks are near the 10-day, and obviously a lot of them got triggered Thursday and Friday, and most of them on Thursday even, and then Friday is just a few left. And so yeah, huge volume. Again, we expect a bounce here, especially you see where it closed at the top, on the top range here, but you know, we'll see how it goes. Again, this is the 10-day slope right now. I expect it to come near that and see how it reacts then. Of course, if we have a bad Monday open this week, this coming Monday, we could also gap down towards the red line here, right? So that's another thing to watch out for before it bounces. So really, you know, when there's a saying, when the knife is falling, you don't try to catch it, and that's what's happening right now, because we don't know, you know, how far it will go. I mean, it could even go all the way to the 200-day as well, right? Just, you know, really kick out a lot of investors here at this range. You know, I'm sure a lot of people, you know, lose their patience once they hit around this level. Here's the IBD 50 growth stocks ETF, and we really felt this breakout right here. We tried it a few times, and this last fail definitely really got kicked in the butt. You can see we are now below the 200-day and really low right here. This looks very ugly right now. Growth stocks are really getting their ass kicked. So we'll see what's going to happen here, but this looks very terrible. Most growth stocks probably are correcting big time right now, and I see lots of ugly charts. So it's going to take some time to, you know, even if you form a base, it's going to take some time. I mean, you know, if you look at, like, for example, right here, this previous base, you know, there's some small rebound, and then it keep going lower a few times before it finally bounced. So, you know, and then it become more of a round shaped base, and that's usually what would happen. So we might see something like this and slowly come back up, right? So, you know, it will take a couple more weeks and so forth. So just be patient. There's going to be lots of opportunities after this correction. Yeah, let's quickly look at the 10-year yield. You can see it drop significantly as now, you know, market really priced in recession fears. Again, no one knows how valid that is, you know, whether we're going from a soft landing to a harder landing. But here's, you know, we are near a tipping point here, 37.92. This is roughly equivalent to, you know, 3.8%, right? And so we are near the previous low right here. So if we sink more, then obviously market is really fearful, and we could have more drops here. So just to look at some of the levels here, 32 was the long time ago, back in 2023 early. So You can also see the US dollar is also hitting a new low, a new recent low right here. So that's a really big gap down on Friday. And this is the oil price, also continue to drop. We are also near, bottom of this base. We'll see how far it will go. This next week we have earnings from Berkshire, Palantir, Disney, and Caterpillar. Let's quickly look at all the spider sectors. Here's the technology sector. Now we are down to 200-day. So this is pretty critical level. We'll see if it bounce from here. Some sort of bounce here. Here's communication. We're just at the 50-day moving average, so this one's quite a bit better than the XLK. Then we have retail. So retail right here, it's kind of near the bottom of this base. Then we have consumer discretionary. Really got hit hard on Friday. You can see now it's at the black line, which is the 200-day. So you can see here, consumer staples actually making new high. People are making fun of like Campbell's soup and stuff like that, making new highs. So definitely there's lots of recession fear right now. This is XLI. You can see it drop here. Then we have materials also drop here. Utilities making new high, you can see right here. This is another defensive sector doing well. Healthcare also doing quite well. You can see it's near new high right here. So that's one sector also somewhat holding up pretty good as it's more defensive in some ways. We have energy moving down. And then we have financials, definitely a big drop this week. And real estate is also somewhat defensive, so here's also making new high. So finally, we want to show you what happened this week. Again, we are in market under pressure earlier in the week as IBD kind of signaled this, and then we had the Wednesday close strong, right, from the Fed news, thinking that everything looks okay, but then Thursday everything reversed, and we start getting more distribution days. As you can see, S&P went up to 8 distribution days, and by Friday, because of the sell-off after the job report, you can see market is now in correction. IBD only recommend 20 to 40% allocation. On the stocks side, you can see we were doing again very well Monday to Wednesday, but then by Thursday and Friday the sell-off began, and you can see lots of stocks being distributed here on high volume. And industry groups, same thing here. Very similar. Lots of groups are being sold. There's still some net accumulation, but overall, when you look at the sectors, again, this is based on net accumulation minus distribution. We're definitely seeing a lot more stocks getting sold, and there's really no sector that's hiding here. And then health is only the one that's more neutral. And you can see financials even got hammered. Pretty much every sector got hammered. So thank you for watching this video. I'm going to be making another video on the stocks list, and up-to-date one based on more recent performance. So stay tuned to watch that to see if there's any potential setup or new leaders potentially after this correction. We should have a new rally. So thank you for watching this video. Please like it and subscribe it and thumbs up. Thank you.